Ever feel lost in a financial fog? Macroeconomics acts like a lighthouse, guiding you towards smarter investment decisions based on the overall health and direction of the economy. Welcome to Do Academy. Today, we're delving into the world of macroeconomics, a crucial field of study for investors navigating the ever-changing financial landscape. Imagine navigating a vast ocean of investment opportunities. The currents shift, winds of change blow, and hidden uncertainties lurk beneath the surface. How do you chart a course towards success? This is where macroeconomics comes in, your compass in the ever-changing financial world. This study that takes the wide lens approach in economics by examining the big picture and analyzing factors that affect the entire national or global economy. This includes growth, inflation, unemployment, and international trade. By understanding these macro factors, we can gain insights into the overall health of the economy and how it might impact individuals and businesses. Macroeconomics goes deeper than just daily headlines. It provides crucial data points that serves as key indicators for investors, which includes: think of GDP as the national scorecard of economic activity. A rising GDP signifies growth as more goods and services are being produced. This often translates to higher corporate profits, potentially leading to a rise in stock prices. However, a too rapid rise in GDP can also be a red flag for inflation. Inflation is the silent thief of investment returns. The CPI measures changes in the price of a basket of everyday goods. The core CPI excludes volatile food and energy prices, providing a clearer picture of underlying inflation trends. As the CPI rises, the purchasing power of your currency decreases. Investors need their investments to generate returns that outpace inflation to maintain value. Want a sneak peek at future inflation? The PPI tracks changes in wholesale prices, offering clues about potential price increases for consumers down the line. By understanding the PPI, investors can anticipate inflationary pressures and adjust their strategies accordingly. Macroeconomics goes beyond static data. It analyzes the dynamic concept of the economic cycle, a continuous ebb and flow characterized by 4 stages: expansion, peak, recession, and throw. Identifying the current economic stage is crucial for informed investment decisions. During economic growth, cyclical stocks that benefit from a rising market, like technology or consumer discretionary, might be a good strategy. As the economy reaches its zenith, caution might be warranted. Investors may consider diversifying into more defensive assets. When economic activity contracts, defensive assets like bonds or consumer staples tend to hold their value better. This is the low point of the economic cycle. The bottom after a recession is typically characterized by higher unemployment and low economic activity. This may be a suitable time to consider value investing. The world is interconnected, and so are economies. Understanding macroeconomics on a global scale is crucial. Global factors that can significantly impact investments include trade agreements, tariffs, and currency fluctuations all play a role. For example, a trade war can disrupt supply chains and hurt corporate profits across borders. Political instability, wars, and natural disasters can create market volatility, requiring investors to consider these risks when allocating capital. A slowdown in one region can ripple through the global marketplace, impacting investments worldwide. Analyzing global economic trends helps investors develop a well-rounded understanding of potential risks and opportunities. By welding the insight of macroeconomics, investors gain a significant advantage. Understanding the economic cycle allows investors to adjust their assets allocation accordingly, potentially maximizing returns and minimizing risk. By recognizing inflationary pressures through CPI and PPI data, investors can choose assets that tend to perform well in such an environment, such as commodities or real estate. Central banks influence borrowing costs through interest rates. Knowing how interest rates impact different assets classes empowers investors to adjust their portfolios. For example, stocks tend to become less attractive compared to bonds when rates rise. Fiscal and monetary policies can significantly impact economic growth and corporate profitability. Understanding these policies allows investors to anticipate potential effects on certain sectors and make informed investment decisions. Macroeconomics isn't just a dusty textbook. It's your essential navigational toolkit. It equips you to decipher the economic currents, anticipate potential storms such as inflation and recessions, and chart a course towards your financial goals. By welding the insights of macroeconomics, you become a more empowered investor. You can tailor your portfolio to ride the economic waves, potentially maximizing returns and minimizing risks. You can identify assets that weather inflationary storms and adjust your sales when interest rates shift. Think about a recent news headline related to international trade or geopolitics. How might this event potentially impact different asset classes based on your understanding of macroeconomics? Share your thoughts in the comment section below. Be sure to like, share, and follow Do Academy for more actionable investment insights.